So welcome guys to another simple video from Stanford Trading Academy, and in this short video we'll be talking about why we find that most of the day traders will always be losing money. Now that in the short term they always lose money. And just before we begin in explaining this short diagram and simple diagram over here, let us think about day trading in a rather simplistic view. For example, most of the day traders will start off with day trading basically because they have small accounts. Now, these small accounts cannot be able to have the objectives that large accounts have. For example, 12% per year on a large account is significant, but when you're thinking about a small account, it is not significant at all. So to leverage the size of the account, the traders or retail traders opt to trade more. In other words, they confuse opportunity for making money. So the assumption is if they can trade 30 times in a day, or even 100 times in a month, or even 1,000 times in a month, it may account for a lot of money. Now, this therefore means that they're always exposing themselves to cognitive errors as they are trading this very many times, a lot of stress as they are trading, because this requires a very robust trading psychology, and the list goes on and on and on. And this is one of the reasons why most of the day traders lose money overwhelmingly, because they're starting from the wrong side of the coin. And any person who's a retail trader, I always advise that they always start the equation from this angle. How much do they have? How much are they willing to put into their account? Now, this will avoid scenarios where to have very many trade opportunities, they go to the shorter time frames, M1 and M5 and the shorter time frames, so that they can get as many trades as possible in their accounts. It always never works. If anything, the statistics show that most of the people that will try to do this will fail. Now, the other interesting thing which we've talked in our core courses is that most of the retail traders think they are exempt from the statistics. In other words, they believe that the statistics do not represent them, that they can come with a small account, trade many times in the shorter time frames, and still make money. Those are the assumptions that most of these retail traders will use. They think they are exempt from the statistics, but it should be a very stern lesson, or it should be clear in each and every person's mind that it is better to assume that you are not an outlier. This actually is the perfect combination for losing in trading, and especially in day trading. The first thing you need to do to lose is have a small account. The second thing you need to lose is you must have big objectives. For example, you want to double that account, and the story goes on, you have $500 or $1,000 to trade on. The second thing that you must have is you must want to trade more times. The third thing is to trade more times, you need to go to the smaller time frames. This is the perfect recipe for losses. In other words, you are bound. If you go below the daily time frame, just because you're trying to combine these four variables over here, you are bound to lose 100%. And most of the people may fight this concept, but I found it to work in most of the people that I've interacted with. They always start here, going here, going here, going here. Anyway, let me not knock a dead horse over here. I think that is enough to explain what I'm talking about. So when I now start talking about this diagram over here, what exactly am I trying to represent? What exactly am I trying to represent when I drew this diagram? This is more or less a representation of the possible scenarios you can have. You can have traders trading on the long time frame or short time frame. You can have traders be categorized either as long-term or institutional traders or retail traders over here. Now, Therefore, you can have 4 possible scenarios. You can have 1, 2, 3, and 4. So what 1 basically represents is this. If you are a retail trader and you want to trade in the short time frames, you are most likely going to fail in the long run. Most of the retail traders that try to combine short-term trading are bound to lose. Now, most of the retail traders that believe that for some reason it is better to be in the longer time frame stand a chance of winning. For the institutional traders, it might apply on both sides. And this over here is one of the key things we insist in our core courses. Try to avoid as much as possible this kind of behavior, trying to come here. But if you try to apply these kind of situation, then it may work for you. Now, to be able to explain this, I would like to use several examples. And the first one is HFT, the classical HFT, high frequency trading. And some of the things that I noticed when I was researching on HFT, one of my friends who actually was a trader, an algorithmic trader for that matter, approached me and told me that he had an algorithm for high frequency trading. And the first question that I asked him is, how good is the infrastructure? In other words, you cannot bring an algorithm meant to trade more than 1,000 times in a day, and you're using poor spreads, and the basic economic or the basic economic of the strategy is meant to be very, very advanced. It's not for retail traders. But anyway, he insisted he wanted to give it a try. And as far as I was concerned, it did not work. And mainly because the infrastructure and the environment was not meant for a retail trader. Now, to really understand what high frequency trading is, most of the people who do not know this is used by most institutions, and it involves entering very many times in a day, more than 20,000 times in a day using algorithms. And most of these trading styles do not really have an economic goal at their heart. In other words, it's basically swapping positions and trying to discover prices for the sake of it, but not making money. But retail traders will try to assume this is for making money. So let us just go through several facts that may help shed light about what HFT is all about, so that we can understand why retail trading and short-term trading is never advised. So as a starter, anyone who's a retail trader thinking about HFT should know the following. Some of those that are using HFT have gone to extreme lengths to actually get the best environment for their systems. And this involves stuff that has to do with execution speeds. In other words, some of these firms over here are using funds or are using principles that are meant to reduce the number of nanoseconds between when they execute the order and when the order actually reaches the market. This means that the nanoseconds that the order is supposed to hit the market is relatively small, and this involves moving some of the servers for these algorithms near the trading exchanges where the orders are being taken to. But that is not the problem with HFT. HFT has the following justification. In other words, it says because we're trading more than 100,000 times a day or so, it means there will always be a buyer and seller at every single price, which means that we are enhancing liquidity. But when you think about it, it is not about benefiting the market. HFT has nothing to do with benefiting the market. It has everything to do with benefiting the trading house practicing it. Because the HFT algorithm will trade so many times that it discovers the price the general population, you and I, are willing to pay for a certain stock or financial product. Now, that is what we call in classical finance asymmetric information, where a person has information that is not generally available to the public. And this, my friends, is what we call a rigged game. It is already rigged against the person who is trying to use that strategy, because the price has already been discovered. by the trading houses, because they're doing it so many times that they can be able to spot which is the price that you are willing to buy or you are willing to sell, and they can do anything with that discovery. Now, that is the problem with HFT. First of all, you do not have the infrastructure needed to actually manage it. In other words, it's a very expensive infrastructure to have. Now, the other thing is, since it is an algorithmic system, it is bound to have errors. For example, in 2012, a company called Knight Capital Limited forgot to update their system, and this led to errors that created trades that led to several $100 million in losses. And of course, this was more or less creating disruptions in the markets, basically because it was an algorithmic system, garbage in, garbage out. If there's an error in the system, there will be an error in the execution, there will be an error in the results that you get. So if you're thinking about HFT, you must ask yourself, what are the rules behind the HFT? What is the logic behind it, and what are the likely problems you will face when you are thinking about HFT? And if you're thinking about using this, just know, if you are a retail trader, chances are that you will fail are very, very high. I'll probably advise this to this group of traders. The next thing that probably most people did not know is what we call the dark pool market, and this is what we call the black market, and it has the following traits to begin with. So the first thing is that about a dark pool is that it is a black market sort of trading environment where traders are basically interacting with each other, but they're doing this anonymously. In other words, the buyer and the seller are interacting and exchanging large amounts of stocks anonymously. It's more or less, it's basically a black market, and it does exist in the global financial markets, especially the markets that are not OTC. It is very, very rampant, and it allows lower prices than what you and I are looking at. In other words, these markets can be able to achieve lower prices than the general equilibrium established by the markets. That is the first thing that they can be able to do. And the major issues with the dark pool markets for the day traders is that it's a serious problem when it comes to the price discovery, because you cannot be able to authenticate as a day trader what is the actual trading price for today and what is the arbitrage or opportunity for mispricing within that price that you think you know. Now, the other problem is that these dark pools or dark black markets use the prices that are set by us retail traders to be able to act as benchmarks and yardsticks for bargaining for that lower price against this. So once the traders use this dark pool to achieve a lower price, they can use that price to trade against the buyers in the ordinary market. Therefore, the odds are already stacked against the trader at this level and at this level. These are just two ways. I'm just trying to show you guys that trading as a retail trader in the short term actually does create problems. So what would I suggest what would be the suggestion that I have for a serious trader? The first thing is the trader must always be humble and assume that the statistics they are looking at, or the statistics which I have just said, represents them. One of the cognitive error is that most people tend to attribute more skill to them than other people. In other words, there's a tendency for people to be proud and think they are not actually under the normal statistics. They're basically statistical outliers. So when they hear people who have taken a $10,000 account and turned it into $1 million account, then they assume that all they need is the strategy this person used. But the reality is that this person is an outlier. This person who can be able to do this is an outlier. And if they were using day trading, again, it's still a tall order. Very few people can be able to achieve this. So being humble basically means have objectives that are within your reach. If you're targeting for 100% per month, just be honest about your psychology and the results you've gotten so far and the trading style that fits you, and see if you can be able to hit this 100% per month. Now, if you're talking over 100% per month, trading an account of $100, then there is a problem right there. But this is what I always say. If you think about an account as small as $10,000, if you have an account of $10,000, for example, this account over here, targeting 100% will be a problem as compared to $1 million account targeting only 10%. This is a possibility. So the first thing that we must look at is, what is the relationship of the trader with money? How are they starting out? And that will tell me how easily they can be able to reach their objective. The second thing I always suggest is that avoid the shorter time frames. By all means, avoid the shorter time frames. Avoid anything below the daily time frame. If you are a retail trader and you have and you're thinking about active investing, avoid by all means the shorter time frames. So have a good objective, avoid the short time frame, and be well capitalized. These three things can help you to be able to survive. In other words, have a fighting chance. These are the three key things that I always insist. But if you're thinking about short time frames, these are the things that will keep haunting the trader time and time again. They'll keep haunting the trader time and I've not talked about the stop losses being chased and all that. But these are the basic ideas that you need to have when you're thinking about being a retail trader, trading out of your home laptop, and you're chasing institutional money. That is just an impossibility if I was to be frank. So I hope this video was educative enough for you guys and shed some light about day trading. And if you like the video, just click a thumbs up and subscribe. Yeah, thank you so much.